ROI channel, the channel that's obsessed with the art and science of return on investment. Guys, if you've seen my weekly market minute, you will know that I'm expecting a hell of a lot more volatility coming towards the end of this year, but also into the next year and beyond. Okay, talk about exactly why that is in another video. For today, I'm going to give you a practical tool that you can use straight away after seeing the video that will help you navigate the volatile markets and on average help you to secure a lower average entry price for your assets as you are going about investing. It's a very simple technique. It's called dollar cost averaging, and I'm sure that you're going to pick it up straight away. So let's get into it. Strategy versus tactics. A quick word on this. Strategy obviously is the destination that we want to end up at, or the overall goal that we're trying to achieve. Sounds so basic, but really, if we're honest with ourselves, we tend to forget this all the time in investing. We get caught up in the news, the huge amount of information that's bombarding us from all different media throughout the day, and we get caught up in the bits and pieces and the short-term things that don't matter and that won't matter in the long term if we're really clear about our tactic, if we're really clear about our overall strategy and what we want to achieve. Tactics describe the specific actions we are going to take to get to our destination. Okay, so if our strategy is we want to go to the beach, okay, how are we going to get there? Are we going to walk, take a bike, car, plane, boat, whatever the case may be? Those are the given tactics to get us to our overall destination. Okay, so let's get into it and apply this type of thinking to our investing, because we're going to have a quick review of our overall strategy and how this particular tactic can be applied to help us get there. All right, brief word. This is our overall goal. We want to put a lump sum in this case, I believe it's $10,000. Over the course of time, we want to have those assets invested and compounding year on year. Okay. At the end of that, you can see what that does nominally to a $10,000 investment over the case of 20 years. And very important to look at the difference between a few percentage points. Okay, so if you've got, I think this is 15, and then that's 17 and a half, and then that would be, I believe, 12 and a half. But it actually doesn't matter the exact numbers. It's just saying an amount that you invest, a rate of return that you think you can achieve, with a little bit of variance to show you the difference between if you get a few more percentage points per year or if you get a few less. Okay, very simple. A few other things that we need to remember is in year one, nothing much is expected to happen. We might be up a lot, we might be down a lot, but if you take an annualized average, it doesn't look that exciting. 2, 3, all these years are the same until we start to get past that first decade. That's when the magic really kicks in. And it's very difficult for us as humans to be able to appreciate and get our minds around that when it comes to these timeframes. Okay. This particular example is using $10,000 just put into any asset, any market that can compound, and without further contribution. Okay. We're going to see how that differs compared to dollar cost averaging in, giving a fixed amount into the markets as you earn that amount, usually is the way it works. Or if you've got a certain amount saved, instead of deploying it, you just choose to ration it out over a given period of time. So the reality, unfortunately, does not look like our investments just going up and to the right all the time. Markets fluctuate for many reasons, human psychology and all sorts of other reasons. Here we've got the intrinsic value of an asset, okay, just sloping up and to the right. That's what that asset is worth. It doesn't mean that's what you can buy the asset for on any given day. Markets are nothing more than auction facilities where it allows you to buy or sell assets. The pricing of those assets are completely up to the buyer and the seller. Okay, so they can pay way more than the expected value of the asset, or the selling price can be listed as way less than what that asset is worth. And we go through these fluctuating cycles. Dollar cost averaging allows us to avoid the anxiety around wondering, gee, this is a really rich market, but it might not change for 3 to 5 years. It might be in a bull market for decades. It can happen, and it does happen. So how do I make sure I'm not overpaying for the asset? One way to reduce that likelihood is through dollar cost averaging, where obviously if you've got a fixed amount coming into the market, when the price is overly rich, you'll be able to buy less of the asset. And that's what you want. When you want to buy less of something that's expensive and more of something when it's cheap. And that's what dollar cost averaging allows you to do. Strategy. What am I doing with this very public eToro thing that takes away from where I really make a lot more money and and have more, I suppose, financial interests? Well, the strategy in investing in general is to generate financial security through investment. Okay, so let's dig into that and find out what that really means. So financial security, defined as wealth, for instance, or net worth, means the amount that I've put aside, the stack of purchasing power, all my assets, all my liabilities, which is really measured in purchasing power, particularly the purchasing power of time units. Okay, not to get too deep and meaningful, but my ability to pay for all my needs, my food, my clothing, my sustenance, shelter, and all that, that is wealth, what I've got spare. Income, of course, is another thing that can give you financial security. If you've got a source of income that removes reliance on selling your labor to get those purchasing units. Okay, that's what we do when we have a job. We work your 40, 50 hours a week, you get paid X amount, you pay your taxes and your expenses, and whatever left over, okay, is the wealth for that week or fortnight. And so what we eventually want to do is take that capital, invest it, that's the process of investment, such that it compounds to a point where we've got a big nest egg, a big stack of purchasing power to rest on, and we can withdraw it without disintegrating that critical mass. And or we want that mass or another mass of purchasing power to give us income at regular intervals so that we can pay our expenses. That's what I am building. That's what I have partially achieved and what I want to achieve at a much higher level now. Investment that outperforms. So how do we measure the success of the investment? Well, it has to outperform inflation. So as we're building up these purchasing units, unfortunately, there is the decay of the value of those units over time. So we're stacking up all our dollar bills, let's say, and the rats are eating some of it every year. There's nothing not nothing, but there's very little that we can practically do about that given the world in which we find ourselves today, other than investment. We also need to look at our investments and make sure that they outperform opportunity costs. So if we invest in a given asset, why did we invest in that asset and not another one? Okay. The way that generally this portfolio will be judged will be its performance against a broader index. Okay. What is that? It's a marketplace. So if we think back to medieval times and you've got your olive oil merchant, your banker, your candlestick maker, butcher, blacksmith, all that sort of stuff. Why do we invest in the olive oil guy and a little bit in the blacksmith, instead of just buying shares in all those businesses? That's what we have to outperform. We have to outperform the market as a whole and generate alpha, as we say in financial terms. Dollar cost averaging is the practice of systematically investing equal amounts of money at regular intervals. We've said that regardless of the price of the security, because we are prone to bias. And particularly if you're like me and you bought into something really early because you are prescient and you can see what's happening. You get in at a super low price. The value of something is $10, let's say, and you buy it in at $1 or $2, and the price goes up to $5 or $6, and you think, man, this is more than double what I paid for it. And it's funny. I know you can see where I'm going with this, but you look at it and go, gee, I'm anchoring. I've got that anchoring bias of what the price is today versus what I bought it at. And so in this case, it's a funny thing, but it's very powerful. We should look at that and say, well, yeah, but it's still the half price or half its value, better to say. We should continue to buy more. But this is where the psychology works against us. And so that's one thing that dollar cost averaging can help. Dollar cost averaging can reduce the overall impact of price volatility and lower the average cost per share. By buying up regularly in up and down markets regardless, investors buy more shares at lower prices, fewer shares at higher prices. We get that by now. Dollar cost averaging aims to prevent a poorly timed lump sum investment at a potentially higher price. That's the idea. It's never perfect. And there are some studies that show that occasionally lump sum investing actually outperforms dollar cost averaging. If you think it right at the beginning of a bull market, you might be better off just loading up with everything you got and then sitting back and making sure you can't do anything silly. Because if you're going into a roaring bull market, you're just going to be continuing to chase the price higher up. We are never going to perfectly time the top or the bottom of a given market, but we can use things like history, historical charts, ratios, and a little bit of macro analysis to avoid those really poorly timed investments. So when the S&P is at all-time levels and you're paying $40 for $1 of earnings, historically that's very expensive. That would probably tell us we should ease up on our long positions. And vice versa, when we get to the point where 2 ounces of gold buys the entire S&P, when we get to the point where you're paying only maybe $8 for every dollar of earnings in the S&P, historically that's reasonable. You might increase a little bit then. But dollar cost averaging takes away that human emotion and that human fallibility of error in judgment. Okay, here's a concrete example of an individual following my portfolio dollar cost averaging. So I set up the portfolio in the master account. The portfolio is currently down in price 12.9% for the year. But this particular investor invests, I believe, every month. And so with that dollar cost averaging, this investor is actually only down 4.54%. So you can see that's a big difference in terms of the performance over time. As we're coming in, as you know, investing a lot at the moment in commodities related businesses, and particularly in the energy sector. They're very volatile. And so this is a great example of how dollar cost averaging can help increase your performance by lowering your average entry cost. So that's a real example, real screenshot. Okay, keeping it real. Don't really like Binance, so I'll get rid of that. But it's a great chart. Okay, visual for dollar cost averaging. Lump sum investment, $800 versus 8 lots of $100 in this case each month. As you can see, this undulating green line represents the market pricing mechanism of what the market is pricing on any given day. Here you can see a theoretical example, but it does illustrate it very well that if you just invest a lump sum, average unit cost at $10, in this particular case, at the end of, call it a year or whatever the period of time is, you're still at $10 for your average unit of this particular asset. So you haven't made money or lost money, 0% return on the lump sum investment. But as we know, the market never stays the same price all year round. It's constantly up and down every second of every day. And so by investing in monthly installments, dollar cost averaging in, the average unit cost for this particular investor would be $8.16. So by the end of the year, even though the market just got back to neutral where it was, they've actually outperformed to the tune of 20% in this particular example. Okay, I'm sure you're getting the hang of it now. A hell of a lot of this is on Investopedia, where I've just taken out some of the best bits and plonked them in there to benefit. Benefit of dollar cost averaging potentially lowers the average cost, automatically invests regular intervals over time. So if you don't really want to have to think about things, this is definitely something that you might want to consider. Relieves a given investor of the stress of having to make purchase decisions under pressure when the market's volatile. This is key because we all say, oh, I'll be fine. I don't get emotional when it comes to markets and things like that. When you start running big amounts of money and when you start seeing your account balance fluctuate by what would be several annual salaries worth for most people, you might be surprised at some of the stress that you feel. Okay, you're gonna have to trust me on this. And so we need to have our disciplines in place, and dollar cost averaging is just one thing, or investing in tranches. It doesn't have to be equally averaged to make purchase decisions. It just takes the pressure off you because you don't have to make the decision in the heat of the moment when the market's roaring or when it's crashing. It can also be a reliable strategy for long-term investors who are committed to investing regularly but don't have the time or inclination to watch the market. Fair enough, lots of people got lives they don't like, or they're not particularly savvy in investing. It's just a very simple way that you can put things on autopilot and still do that important work of taking some of your capital, investing it for the longer term, such that you can stack up those purchasing units. Okay, you can build your wealth over time and reduce your reliance on trading your labor. That's all for today. A bit of basic sort of mindset stuff, but I think it is very important, particularly coming into the environment that I'm expecting. I'm expecting a lot of ups and downs. And so I hope this helps you feel better about things and give you something really practical that you can take away and implement over time. Thanks for watching. If you haven't already liked and subscribed, I'd appreciate you doing that. If you're interested in a value fund on eToro, I'll put the link in there. You can add my fund to a watch list, or you can copy the portfolio. Okay, completely up to you. I'm on Twitter at the ROI channel. I'm trying to be more active, but I'm just very busy throughout the day. And that is it. Disclaimer, guys, I'm not a financial advisor. Thank God. I don't know your circumstances. So please, nothing I say here is advice. This is my opinion. This is what I think. This is what I'm doing. It may not be right, number one, and it may not be right for you. So I make no guarantees about anything on this channel. And I do stress that none of it is advice. It's purely my opinion. And you need to take that into consideration, and you need to take responsibility for your own decisions. Having said that, I hope that you enjoyed it. If you're interested in learning more, or if you have any comments, please do put them in the comment section. We've got a great group of people that comment and put some interesting ideas out there. I really enjoy reading them. Thank you for watching, and I'll see you in another video.